Hi and welcome to another episode of Monday Market Outlook. This is an exciting time for both the PSE and the global markets. Let's see what we can look forward to this week. So for the Philippine Stock Exchange, we are currently consolidating here at the trend line resistance. Remember, we plotted this trend line resistance last week, which goes all the way from 2018. So we are currently at this resistance level of around 7,100. Hopefully with the strong local market, we can see further upside to around 7,170 before it corrects and moves into a price channel. But for this week, we're waiting for the official GDP numbers, which will come out on Thursday. So some analysts are saying that we will grow by around 7.1%. Some analysts are saying that the Philippine economy grew 7.5%. Others are saying 7.8%. Now, we will know the official numbers this Thursday, and that might decide where the market will head next. But as of now, most of the estimates are actually above the estimated 6.9%. So this is pretty good news for the markets. It's either going to be sell the news or the numbers will invite more net foreign buying in the coming days. Now, if we look at this chart from Mike Tan, thank you to Mike Tan for providing these charts. The Philippine market breadth is at one of its highest levels. Almost 50% of the PSE stocks are above its 200 moving averages. And if you look at the trend breadth here, there's a clear shift from weak uptrend, no trend, to a strong uptrend sentiment. And usually after this type of movement, we may see some rotational actions. Looking into the stocks that we're monitoring, of course, when we say rotational action, this goes to the second liners. This would be your Apex Mining, your Bloomberries, and currently second liner Union Bank. So in the past 24 hours, we still see Figaro Coffee, DNL, Cebu Pacific, Union Bank, Bloomberry getting most of the action. So most of these stocks are already in our portfolio, and during this time when the market is in a strong rally, this is a great time for us to really just hold, sit back, relax, and enjoy this, right? As Jesse Livermore said, no? Money is made by sitting, not by trading. Don't force the trade. Just sit back and enjoy the show. Moving on to the global markets, the big news last week was the Netflix subscriber growth surprise. I guess Reed Hastings was still able to pull a rabbit off of his hat before he announced his departure as Netflix CEO. This is a surprise subscriber add, 7.6 million as compared to 4.57 million estimated, right? This was good news, especially after Netflix introduced their ad-supported tier. This propelled the Nasdaq to retest its trendline resistance here. So it's going to be make or break for the Nasdaq this week if we are able to overcome this resistance and maybe hit our next gap fill at around 12,000. But for the S&P 500, after retesting this downtrend line, there's a strong rejection here at that level, which brought the index down to 3,890 before it recovered the next day after JP Morgan announced that recession odds have improved from 98% in October to only 73% this December. So clearly, the S&P 500 is in a fight the Fed mood for this week. This might retest here, or remember that we still have to fill the gap to this critical support level, 3,750. The direction that the S&P 500 will make could be swayed by blockbuster earnings calls this week. We have big names like Microsoft this Tuesday and Tesla this Wednesday, as well as the continuing earnings call for the financials like Visa, MasterCard. This will show us the consumer spending habits and see if there is a reason for the Fed to be worried about recurring inflation. From all this optimism, the rotation to technology, rotation to semiconductors, and communications clearly show a risk-on appetite for investors. If we look at the bigger picture here, we need to take into consideration a missing piece of the puzzle. While all this optimism and this fight the Fed sentiment is ongoing, we have to remember that the Fed is still hawkish, and for good reason, because consumer sentiment is still very high, right? While the job creation in the US has gone down significantly, the unemployment rate is still a problem, and this is the missing piece of the puzzle. The Fed was expecting a 3.7 unemployment rate, and it came in better than expected at 3.5%. So this is a big problem because the target for the Fed is to hit 4.7% unemployment rate. Now, why is the Fed hell-bent on making Americans jobless, despite everything that we've heard about Microsoft laying off workers, Facebook laying off workers? I mean, tech is only one part of the equation. If we look at the change in non-farm payrolls last December, while you have professional and business services and information on a negative, there's a significant amount of demand still in other sectors of the US economy. Because if we go back to Fed Chair Powell's statements about the absence of direct political control over the Fed decisions and price stability, what he was basically referring to is a repeat of the 1974 recession. Now let's look at the chart here comparing what is happening today and what has happened in the 1970s, because during the 1970s the US was also experiencing high inflation and the Fed had to increase interest rates. The problem during that time was that during the Nixon administration, as he was losing popularity, he was pressuring the Fed to pivot interest rates earlier, because he's going to become more unpopular if unemployment rate rises. So the Fed gave in to this political pressure, and look at what happened. Inflation came back with a vengeance and even went higher. So the Fed wants to prevent this from happening again, which is why when the Fed keeps saying that they will keep interest rates elevated for a longer period of time, this is what they're trying to prevent. Because what's the relationship of interest rates and all of this? We are in a unique situation right now in the US. There are three types of inflation. Either it's demand pull inflation, cost push, or built-in. And we are in a special situation right now because all three of these factors are affecting inflation in the US right now. Like demand pull, I mean revenge spending and all this consumer sentiment after the pandemic, right? Cost push, right? Supply chain issues, the rise in oil prices, and built-in inflation, right? Built-in inflation is wages, a rise in wages, right? So for cost push, it's easy to think that inflation has peaked on a cost push perspective because prices are going down, commodity prices are going down, oil prices are going down. But demand pull is still there. Consumer sentiment is still high. And why is it still high? Because a lot of people are still employed, and not only are they employed, but wages have increased. So in order to decrease consumer demand, more Americans need to be out of a job. Before we can reduce wages, more Americans need to lose their jobs, right? And this Americans losing their jobs is a very unpopular scenario for the current administration, right? So how will all of this play into the Fed decision to keep rates higher for a longer period of time? They want to see more Americans lose their jobs, and this is going to feed into earnings later on in the year. And how bad are we going to land when this happens is anybody's guess. Right now we are very optimistic that we are going to have a soft landing. We need to monitor this until the first half of the year and see where we are and reevaluate. But for now, like I said, it's just enjoy the ride and enjoy the rally while it's there. So that's it for this week. I hope you found this episode useful. Please like this video, subscribe to the channel, and I'll see you next week. Good luck on your trades, and remember to manage your risk accordingly. Thank you and good day.